how are you? Hope you're doing well. My name is Isma, and today I want to talk about the strategy we actually use when we are trading gold. Because I've gotten so many requests, so many people are out there, so many of my students have asked me the appropriate and the best way, the best strategy of how you can trade gold. Uh, when it comes to trading gold, some platforms or some blockers will not literally provide gold as gold, like on when we come to actually among the instruments, among the pairs, among the indices, or among the instruments that are available for any broker or for any brokerage company to be traded. They don't exist. They don't appear. It doesn't appear as gold, but it would rather appear as XAU slash USD. You get it? Like the way we see it here clearly. Now, when we are actually trading gold, there are certain concepts that we need to know, we as traders that are about to trade. One of which is the correlation coefficient. What is the correlation coefficient? Just like any person would ask, the correlation coefficient isn't anything related to that of the coefficient of mathematics, the 2x, but rather is basically the number that describes the extent to which two instruments are correlated to each other. In other words, how are the two instruments related to each other? So this is what explains that if this and this, or if such and such an instrument increases, then what do we expect of the other currency? So we're looking out for a relationship. That's what we refer to as the correlation coefficients. Like for instance, when you look at oil, we would say that when you look at oil and Canadian dollar, these are two different instruments that when one increases, the other also automatically increases. So that's what we refer to as the positive perfect correlation. You get it? So a correlation is just like a number, just like any other numbers, but only that on a spectrum it appears from -1 to +1. In other words, it's between 1 and -1, or -1 to +1. So that's what we refer to as a coefficient. So it shows a relationship between two instruments. Now, for this time round, we're looking at gold, and also we're looking at the US dollar, because when you critically remember very well, when you go to the history of the dollar and gold, they were pledged not until it reached 15th of August 1971. And after that, by around 1973, the dollar index was invented. Since that time, it has been moving, or it has been in existence. And what the dollar index reflects, it reflects the current, or it reflects the economy, or the current stand of the United States dollar, of the United States, of how it's apparently operating. Now, when you look at gold and the dollar, they have a negative correlation. A negative correlation means that the two of the instruments, they move in the opposite direction, but to a certain degree that may actually vary. So before we come to that side, we need to know which is the standard measure of gold before you can trade gold. Which is the standard measure of gold? What do I need? Which is the current price of gold? How relevant is it if I'm trading gold, and how is it in particular? How worthy is 1 gold or 1 kilogram of gold? How worthy is it? In other words, now the standard measure of gold is called ounces, or it's an ounce. An ounce is actually what is valued here on our MT4 platform, or on all brokerage or trading platforms. Now, an ounce is literally equivalent to 0.028.27 kilograms. Are we together? And now, for you to get the worth of 1 kilogram of gold, it will literally mean that you will have to multiply, you have to convert the ounces into a kilogram. Now, it will mean that you will need 35 point something ounces to come up with a kilogram of gold. So, which will mean that you need approximately 60,000 something few dollars to buy a kilogram of gold. Let's get away from there. Let's see of the perfect strategy we can use when we are actually trading gold. So among the things that you need to know is the index, the US dollar index. It stands, and when you know how it's apparently standing, you identify its support and its resistance. Then you're in position to know the best ways through which you can trade the XAU USD. Now, like we all know, the XAU USD is a gold index, which we refer to as the spot gold. Now, let's first see, if we were to trade gold, how are we in position to tell that now we should buy, we should sell our gold? So first, you need to first get the US dollar index. You know its stand, identify its support, and identify its resistance. What we'll have to do is us to go to our browser, look for the US gold index, US dollar index. Let me make it a bit bigger. Let's go to TradingView. Go to your browser, type in tradingview.com, look out for US dollar index, and then it will appear like this. But then let's have a full featured chart that can easily show us how the current stand of the United States dollar index is. So this is how TradingView appears to be. So it's also another platform from where we can do our technical analysis. Now, this is how it has been. This is how it's apparently standing. Let me first identify my support and resistance. When you critically look, we have a resistance here, and then we have the supports at that point. So if this market is to come, when it reaches our resistance normally, and it shows that it is really bouncing off the resistance, it will mean that now we expect the dollar to reach here. When it reaches here and it bounces off down, where the next move that we'll have to do, it will mean that the dollar itself will have to lose value. Apparently, when you look at the dollar, it has been moving within a range. Okay, it has been moving within a range. So as identifying our resistance, if like the same way this market reached here, it came down, it came back, it reached here, it came down. So we also expect the same move, and when it reaches here, this is the best time, the best place from where we can actually tell of the exact movement of the future movement of the United States dollar. So when it reaches here, it will mean that we will be expecting it to do as it has been doing, or as it has done in the near past. Because when we look at technical analysis among the three basic principles, one of which is market action, or markets do repeat themselves, or history repeats itself. So if it's the same thing happened here, it happened here, so we expect the same thing as well to happen here. But all we need now will be a confirmation that will really tell to us that this market is apparently will be going down after having the confirmation. So when this market comes and reaches this point, which is now our resistance, what we'll have to do, because we said when we are actually looking, or when we are trading the correlation with the method of the correlation coefficients, we see that we have two values. We have the positive, that is ranges from 0 to positive side up to +1, and from 0 to -1. So if there is any value, or if there are instruments that are negatively correlated, it means that these two instruments are moving in the negative side. Like for instance, when you look at gold and when you look at the dollar, they are negatively correlating. In the history, according to my own observation, around 2011 and 2012, there was a probability of approximate negative correlation between negative 0.6 to negative 0.8 correlation of the United States dollar and gold, which meant that these two were moving, but with a varying degree. They are moving in the opposite direction with a varying degree that was either of 60% or 80%. So when the dollar here, the dollar index is to reach here and it's to come down, automatically it will tell to us, having it confirmed that it is going down, it will mean that what is happening to the gold, or the gold index will be, or spot gold will be, that if this one is moving down, the other one will automatically be moving up. Just like we said, if there is a negative correlation between the two instruments, we will now be expecting the opposite movements. That if this is moving up, this will be moving down. Then, if it's a positive correlation, it will literally mean that the two instruments are, in other words, moving in the same direction but with varying degrees. I hope you're very clear. I hope I'm very clear. If you really miss out with understanding deeply what I'm explaining in this video, don't forget to share with me. Share with the friends and contact me with the contacts in this video. Let's proceed. So having noticed that we are having made an assumption that if this is actually reaching here and it's reversing down, it will show that the dollar will be going down. It being a negative correlation, it will mean that automatically gold will be moving upwards. So we go back to our gold. You see, go back to our gold, and then what we are supposed to do will mean that markets confirming in the United States dollar index will mean that it's going down. It means that in the dollar index it will be going up. So if it's going up, what do we do next? So we have noticed the next move of the gold index. So what we do, we apply our own customized index or oscillator, which is called the ATR, average true range indicator. So we come and look out for our average true range indicator, average true range ATR. When you look here, it's not here. Average true range, because fact being that I've used it, you can look out for it and you will not fail to get it. But I have it already here. Having clicked on it, normally the oscillators or the indicators that you've actually clicked on will always appear above here. So average true range, which is the ATR, is what we put when we are trading with this strategy. Now, among the things that you need to pay attention to is the time frame, the indicator used, and the currency pair to be traded. Now, the time frame to be traded with this or with such a strategy will literally be the daily time frame. Okay, so the time frames are somewhere above here: 1 minute, 5 minutes, 15 minutes, 30 minutes, 1 hour, 4 hours daily. That's what I mean, or that's what I want. So when we click at the daily time frame, automatically it will mean that each and every candle that is within this time frame must have lasted for a full day. So then we put our average index. So having noticed the direction of our next move of gold, which will be an upward direction, to let me pause a bit to give you a review of the gold movement. Now, for the past 100 since 1973, gold has been on a bullish movement. It has been on a bullish movement not until it reached 2011. It was on a straight movement. In other words, this means that, or a bullish movement, it means that gold was only increasing in value, not until it reached late 2011, whereby it just moved out, and that alone marked the highest price of gold, which was approximately or around $1,920. So with proof, we can prove this. They are not my words, but it's out of experience and the observation that I normally do in my charts. So this is the gold chart. Let's go at the weekly time frame. Actually, let's go at the monthly time frame, such that we're in position to view. To view the gold market, since they are. Let me show you. Since they are. Actually, let me increase. Since they are 2000. So this is what I'm actually talking about. It was on a straight movement, not until it reached the year 2011, which was, that's where we had the highest price. It's here 2011 in the 9th month. That is first of the 9th month. So it was on a straight movement, and then the price, or the highest price gold has ever been ever since, was $1,920. $1,920. Yeah, it's here. This is the fact, and then that's when it went a bit down, and we now expect gold to go up. So the chances are high that when gold reaches this price above here, it may either reverse down or it may break, which we refer to as a breakout. But for the next, let me share. Yeah. Before the 9th month of 2020, we expect gold to be on an upward market movement. And then the rest that will come after that will be on what we'll be actually seeing on the current stand when those days, or when the future comes, like we do expect. So let's go back. We've had that information, and we've got to notice the highest price gold has ever been. That was 2011. Now, since we know that we're going to buy, how do we determine where to put our stop loss? How do we determine where we put our take profit? Now, the reason as to why I'm applying the ATR indicator. The ATR indicator shows the volatility in the markets. The reason as to why you see this, it isn't literally working the way you see this. The RSI is working the way you see the stochastics do work. For it shows the volatility in the market. That's why you're in position to see here. It showed that the volatility had reached maximum. That's when this was moving up, and this was moving down, and for it was moving up. The reason that's why it was moving up, it was showing to you that the volatility for a downward movement was going higher. That's why it's more of a hill, and it was showing the strength of this market, or the volatility of this market. So the higher the volatility in the market, let it be downwards or upwards, the higher the ATR. So what we do is, when you get, or when you put your stop loss, normally you get let's say if you're to enter from this point, your stop loss will actually be the ATR. This ATR, the value of the ATR, for instance, will get 2458 pips times 2 will be the position where you will be putting your stop loss. And knowing where to put your stop loss will literally be defined by the risk to reward ratio that you are apparently using. Now, when we are trading gold, I encourage you guys to use a 1 to 3 risk to reward ratio. In other words, if you're risking 10 pips, make sure your take profit is at 30 pips. Thank you very much. Thank you for being patient to listen from this video. If you find it so helpful, don't forget to share, don't forget to like, don't forget to subscribe for more videos or for more YouTube videos. Stay home, stay safe. I've been Ismail Sewankambo. Don't forget to contact with the contacts in this video. Have a blessed day. Bye bye. Hope you found this video helpful. Don't forget to share with me. Have a blessed day.